Good afternoon, everyone. This is Mike Desiato. I'm a member of the Growth Tribe community. Many of you may have met me before, but I'm a CPA, exit planning advisor, and also a growth driver as well. But thank you for joining me today. And, over the next hour, what I'm going to try to walk everyone through is some strategies that can mitigate, or in some cases, completely eliminate income and estate taxes in connection with the sale or transfer of a business. This isn't a sales pitch. It's really a high-level tour of real techniques with real numbers so that at the end of the hour, you'll recognize what's possible for your clients' businesses, ideally well before they ever sign a letter of intent. And we're going to cover two big buckets today. First, and this will take most of our time, what you can help your client do before the sale to get ahead of the tax bill. And then secondly, toward the end, what's still available after the sale if no planning or planning hasn't been done at all or hasn't been done in time. So let's get to it, okay? So quick note on how to use this hour. Think of every strategy that I talk about as a lever on a dial, not a silver bullet. Most real plans end up combining 2 or 3 of these, not just one. And I'll flag where these techniques go well together as we go along. Let me move this up. Okay. So how much can income taxes take from the sale of a business, right? So here's a question I want you sitting with you for the next 60 minutes. Again, how much can income taxes take from the sale of a business? Well, the answer is it could be anywhere from 0 all the way up to and exceeding for 40%. So let that spread sink in for a second. 0 to 40%. That's the entire thesis of this webinar. Every single strategy I'm about to show you is one lever that moves you toward that 0% away from that 40%. And why is this range so wide? Well, there's a few reasons for this. It depends maybe on your entity structure, if it's a C corporation or whether it's a pass-through entity, if the transaction's a stock sale or an asset sale, how long you've held the assets, have you done any advanced structuring before the deal, and even which state you live in, although I will only be addressing the federal income tax consequences in this webinar today. So I won't be talking about state taxes. So let's start with two of the easiest wins in this entire presentation. And one more thing that's worth saying up front. None of what moves that percentage is about hiding income or taking an aggressive position. Every strategy in this deck is well established, IRS recognized, and it's the kind that's built on decades of case law and clear statutory authority. The 0% number on that spectrum is earned through structure and timing, not by taking crazy risk. So let's get to the first kind of, I call it a very simple strategy, but it's something that's often overlooked. Okay, let's talk about a pre-sale simple gifting strategy. So let's start with a case study. Imagine you have a business owner that has a $10 million company, and she owns 100% of it. And she has 2 married children, right? Both working in the business and both with taxable incomes under $100,000 a year apiece. And the company is about to be sold in the next year or so. So here's a planning move that she could do. Very simple. Before the sale closes, she can gift 5% to each of the kids of the company, preferably non-voting stock, so that she can keep full control to each of her 2 children. Excuse me. So let's do the math together, right? On a $10 million deal, 5% works out to about $500,000 of gain, essentially, shifted to each child. Now, here's why that matters. If I add $500,000 on top of that child's existing $100,000 taxable income, that pushes up to about $600,000 of taxable income, okay? And they're married, filing jointly. So that's high enough that some portion of that capital gain on the sale of the stock will land in the 20% tax bracket, the capital gains tax bracket, but a meaningful slice of it, most of it, is going to fall in the lower 15% tax bracket, all right, for capital gains, which is exactly where it wouldn't have landed if mom would have kept the entire all the stock and sold and paid tax on it. So the number here is very interesting. So if you have $500,000 of gain at 5% tax savings, because you're going from 20% to 15%, that's about $25,000 in savings for each child, and for two children, it's a $50,000 total savings for the family. So for a gift that really takes no advanced structuring and no real planning at all, it's just an outright gift. So a couple of quick things here, though. If you do something like this, if your client does something like this, they're going to have to file a gift tax return, report it. They could, and they probably will, apply valuation discounts for the fact that she's giving away minority interests, and that will draw a discount on the gift, and it's going to have some estate tax savings. So I like opening with this study because it proves something very important. You don't need exotic trusts to save real money, right? Sometimes something as simple as this can save real money, $50,000 for the entire family. So that's an easy win. Let's move on to something else that's not so complicated and is another easy win, as I see it, of course. And that is another fact pattern I see constantly, where we have real estate that the business operates out of that isn't used, and it's not owned inside the operating company. It's held in a separate entity, and it's leased back to the business. And in this case, the real estate's not going to be sold as part of any sale deal, of sale of the company. And the owner plans on holding on to it, collecting rental income until they pass away. So it's a long-term asset hold. So the question becomes, look, is there anything that we can help this owner do with that real estate in the year of sale to help with the tax bill on the business sale? And as you probably have surmised, the answer is yes. Okay, you can do something, and it's called a cost segregation study. And for those of you who don't know what that is, what a cost segregation study does is it takes a look at the building, which if you, under tax law, if you have a building, commercial building, you normally depreciate that on a straight line basis over 39 years, okay? But what a cost segregation study does is it goes into the components of the building and breaks them into their components. It breaks it down into electrical system, flooring, parking lots, landscaping, and each of these separate components, and I guess that's how the segregation comes up. They segregate these separate components, and most of those are going to qualify for a much shorter recovery period, usually 5 years or 7 years. All right. And what happens when you do this study is those shorter life components can generally now be expensed in full in the very year the study is done. Okay. So you don't have to go back and amend returns. When you do the study, you identify these things. If they qualify, they generate an immediate deduction in the year that the study is done, not the year in which the property was placed in service. So you don't have to amend tax returns. And here's the punchline here. By creating a large current year depreciation deduction through this study, you most likely will generate a rental loss on your return, and that loss can be used to directly offset the gain recognized on the sale of the business. So you're turning an ordinary depreciation deduction on a piece of real estate into a direct offset against the single biggest probably income event of the owner's life. And there's a second benefit here as well that plays out over the decades. If the owner holds that real estate until his or her death, her heirs are going to get a full basis step up to fair market value at their death. So the depreciation recapture that normally would occur if you sell the property, you give back all the benefits you got and you have to pick it up as ordinary income. That's not going to happen. That entire gain inherent in that property escapes taxation if it's held until death and passed on to the heirs. So that's an interesting opportunity there. So one quick thing, though, that's worth mentioning here for the technical types who are listening, this only works cleanly if that rental loss isn't trapped by the passive activity loss rules and the self-rental rules and the passive activity loss rules. And so this is a conversation that worth having with the client's CPA before the year they plan on selling the property, because there's a way of avoiding that passive activity loss trap. Okay, so those are two quick wins. Those are two pretty simple things that can be done. So let's turn now to getting, now we got the tax bill down in a way. Let's talk a little bit about the next topic, which I think is important, and that is keeping the people who actually built the value of your company on board, right? We want to make sure that we can keep them on board and keep them engaged. So here's a case study, and it has tax implications, and that's why I'm talking about it, right? Because a lot of people want to keep these folks employed, they want to keep them tied up, but there's tax benefits involved. So here's a case study where we have an owner who wants her key employees to share in the value they've helped build, right up and through the eventual sale of the business. Not only that, but she wants that value taxed to them at favorable capital gains rates, not at ordinary income tax rates. All right, and that spread could be substantial. Could be as much as 17 points. So, and usually where I find this happening is the company is typically an S corporation, right? So we have an S corporation, and now the owner wants to give her key employees some type of interest where when the company is sold, they get capital gain treatments. So the way you can do this, and I've done this, is that you have to reorganize the S corporation, and it's a tax-free reorganization, into an LLC. And then when the LLC is formed, the owner then issues non-voting profits interests to those key employees. And with that, when that happens, there's no cash that the employees have to come up with, and there's no tax hit. There's no tax bill on the grant of those interests. Now, that wouldn't be the case if the owner gave away stock in her S corporation. If she did that, that would be compensatory and it would be taxable. But here's a way of getting equity interests in the company tax-free in the form of profits interest to key employees. And I'll flag this now because you're going to see it several times today. And whenever an owner wants key employees to share in future upside without cash out of pocket or tax effects, the conversation almost always starts with the same questions. Are we going to give that person a profits interest, or are we going to give those persons phantom stock? So let's talk about profits interests, and then we'll get to phantom stock. So this diagram is a little messy, but I think you can follow it. So let's look at how this flows. So the original owners, we'll call them Mr. X and Mr. Y. They reorganized the S corp, and they now own an interest in an LLC. And then the LLC grants non-voting profits interests directly to the key employees, in this case A, B, and C. And here's a structural important point to point out here. You generally, again, you can't do this cleanly inside an S corporation, which is why you have to convert to an LLC first before you give the interest away. And look at the little call out on the right there. When those profit interests are taxed, when the business is later sold, it's taxed at capital gains rates, as long as the holding period requirement is met. Now, with profits interests, the tax rules say that the person who gets the profits interest has to hold them for 2 years, not 1 year, 2 years, in order to get this favorable capital gain treatment. But that capital gain treatment is one of the entire reasons why employees prefer this structure over, say, a cash bonus or phantom equity, which is taxed at ordinary income tax rates. I guess I have to move the slide up a little bit here. Yeah, so again, it's no cash out of pocket from the employee. They carry no tax on the grant, and they reward them with capital gain treatment. So let's talk a little about the profits interest themselves. So let's go through this as a checklist of this. So what do? What does the profits interest do? Well, it incentivizes the performance of the employee, right? You align the employee's personal upside directly with the company's growth. Again, there's no cost or no tax on the grant. No cash is required and nothing to report as compensation income the day it is issued. It's a powerful retention and attraction tool for the people you most want to keep. And it also facilitates leadership succession, which if you're thinking about your own exit in 5 to 10 years out, it's exactly the kind of thing you want in place well before you're ready to walk out the door. And I've seen this structure used a number of times, again, to retain a management team all the way through the sales process without really substantially diluting, the owner's economics until the deal closes. Okay, let's flip the switch now. Let's flip the scenario. Here's a different owner, and a different preference, right? He wants to give his employees, he wants to share the value that they help create, but he does not want to give up any actual ownership. Not even non-voting profits interest not even that is on the table for him. So when an owner wants zero equity dilution, full stop, no exceptions, then phantom stock is usually the answer. And what is phantom stock? Well, phantom stocks rewards your key employees without giving up equity. I want to pause on this distinction for a second because it's one of the most common questions I get from advisors. Profits interest and phantom stock solve the same business problem, rewarding key people, but they land in completely different places on the ownership versus cash spectrum. Knowing which one your client actually wants, ownership or no ownership, is really the first question you got to ask before anything else. What do owners typically like about phantom stock? Well, first, there's no dilution. No real shares are changing hands, so the cap table remains the same. Secondly, it's a genuine retention tool. It comes with vesting. I mean, these phantom units are vested over time, and the payout dates keep the people focused on the long haul. And thirdly, it aligns incentives with value growth. The employees benefit from the value they help create without ever actually holding stock. And the way I like to summarize this is phantom stock behaves like equity compensation on paper, but legally it's a contractual bonus arrangement. Okay, I'll add one more thing that the owner really appreciates too, that make this slide, that's not on the slide, but it's important to note. And that's because there's no real equity change in hand. And as a result, there's also, again, no need to amend the cap table. More importantly, no new shareholder agreements to renegotiate, and no additional voting rights to worry about down the line. So from a legal cleanliness standpoint, this phantom plan is really a much lighter lift than issuing real equity. So how does it work? Let's talk a little bit through how this works. So in plain English, I'll break it down into 4 steps. Step 1, you have the company granting a hypothetical or phantom unit to key employees or key employee. It could be one, it could be many. You can discriminate. And step 2, those units vest, and they're tied to time served, or the vesting is tied to some performance milestones. Step 3, the value of those units is tracked using an agreed upon formula or independent appraisal. And step 4, a trigger date, retirement, sale of a business, or some fixed date in the future. At that point in time, the company pays out, usually in cash, though some plans allow for stock. And one practical tip here, step 3, that valuation formula is where disputes end up happening. So I suggest that needs to be defined precisely in a plan document, ideally using the same valuation methodology the company already relies on for its regular business valuations. Let's talk about when this is a good fit. When is this the right call? Well, it's a strong fit when the owner wants to reward a small leadership team, protect control, avoid dilution entirely, and build value sharing that supports a future transition or sale. Most owners reserve it, again, for a select group of leaders, not the entire workforce. You can discriminate with a payout tied to a triggering events like a retirement, termination, fixed date, or the sale of the business itself. So now here's the key tax point I want to call out directly, because it's the trade-off versus the profits interest structure we just covered. Payouts under the phantom plan are taxed as ordinary W-2 compensation to the employee. Okay, it's ordinary income, W-2 comp, it's deductible by the company, and it's not capital gain income to the recipient. So phantom stock, again, and profits interest solve the compensation problem. That is getting your key people financially invested in the outcome. But let's now talk about what happens when the owner wants to sell his ownership interest to people who can run the business, but don't have the capital to buy it. Okay, so let's talk about transfers to insiders who don't have the capital to buy the business. Happens a lot. Well, it doesn't. Yeah, it does. I mean, I think a lot of sales these days, especially for smaller companies, are internal transfers. And so before we get into any specific structure, whether it's a two-step plan I'm going to cover, the old co, new co split, or the serial redemption plan, I got to plant a flag here because everything in the next several slides depends on it. So in my mind, there are 5 things that you need to know, or a client needs to have in place or needs to have knowledge of before choosing any of these inside transfer structures at all. And the first one that you need to get a handle on is the value of the company. What is the business actually worth? The second thing they really need to get a good handle on is the company's free cash flow. How much money is actually available year over year to fund these transfers? Thirdly, what's the owner's walkaway number, right? What does the owner personally need to receive to be financially secure from the business? And this is a deeply personal item, and it's not the same. It's not the same as the company's value. All right, it's what the owner needs to get from the business in order to be financially secure when they leave. Fourth is what's the owner's time frame? How much time are they? How many years do they have until they walk away? And 5, and probably the most important part here, is do they have employees? Do they have employees who are able, willing, and want to become owners? Okay. Not only are they able, but do they want to become owners? Meaning that they understand the risks and rewards. They understand they're going to have to pledge personal assets or sign guarantees. Sorry about that. Sign personal guarantees on notes. I mean, they have to be willing to be owners. So if the answer to any of any of these, or if the answer to this particular question is no, then none of what follows is the right path for you. You're going to have to look maybe to a third-party sale. You may have to look to building wealth outside of your business to fund your retirement, or you may want to hold on to your business as an owner and hire professional management to run it. So, assuming that all 5 boxes are checked, all right, let's walk through exactly what can go wrong with a plan once you have this in place. What can go wrong if you don't do this correctly? So let's talk about
fascinating stuff, Mike. This goes straight to the heart of so much of what we discuss in the community. Thank you.
Oh, you're welcome. All right, so let's talk about. I hope so. So let's talk about what can go wrong. I warn people about this, and I hope people. I want you to see this, because if you don't do any planning, and let's just start what happens when there's no advanced planning. The owner's tired. They want out, right? They're just burnt out. They want to leave, and they don't want to stick around. They don't want to do any transition, more planning, or anything else. So the only mechanism they kind of leave themselves with is selling all their shares to these key employees for a note, right? I want out. I'm going to sell my shares and give me a note, and I'm out of here. Okay, so here's a typical setup, and that's a scenario. Let's say we have a $10 million business. We have a business that has $10 million of projected future cash flow. And and 100% of that is going to go towards buying the owner shares. Now, walk through the math with me here, because this is where it gets crazy. So, and this is from a tax perspective, right? So the insiders are going to use that company cash flow, and they're going to have to pay tax on it first. So that the new owners are going to get that cash flow, and if they're in the 30% tax bracket, so now $3 million of that $10 million is going to tax before they can use any dollar to pay the owner. So that leaves them with $7 million of after-tax cash flow. And now it's the owner's turn to pony up. So now the owner is going to take that $7 million, and assuming they're in the 20% capital gains tax bracket, Uncle Sam's going to grab another $1.4 million in tax. So what lands in the owner's pocket of that $10 million? $5.6 million. Okay? And this is, I'm talking about an S corporation here, right? I'm not talking about selling a C corporation. You got tax on the company cash flow, and then you got tax on the sale of the company's stock by the owner. And I'm assuming their tax basis is pretty small here. So what's happening is 44% of the company's cash flow, which is $4.4 million, is gone because of this double tax effect before it even reaches the owner. So I want to also be clear that this is not just a tax efficiency problem. It's also a risk problem too, right? Because until the owner gets that note fully paid off, your client's holding an unsecured promise from a group of insiders who, by definition, didn't have the capital to buy them out with cash in the first place. And there's no real collateral behind that note. If the business struggles or the buyer group can't complete the payments, the owner has very little recourse. I mean, yeah, they can get the business back, but it's probably run into the ground. So this is really what could happen if the owner doesn't want to do any planning and just gets tired and just says, I'm out, and they sell their shares and they take a note back for the entirety of the purchase price, or they want to sell their company, and they wind up in this situation, which is probably the worst situation that they can find themselves in. Okay, so just be aware of this. I mean, it's the worst place you could be in. And again, this is what happens by default without any planning, and you should avoid it. And the good news, you can avoid it, right? So let's go here and talk about another way of handling this, right? I call it a 50-50 stock and direct payments methodology. So here's a more preferable approach using the exact same facts, same $10 million, same tax brackets. The only thing that changes is how the cash flow gets paid out. So instead of using all the cash flow to buy the owner's stock, I say split it. I say, let's use $5 million to buy the shares. And in this case, if they're only buying shares over time, they're not buying 100% right away, then they can sell those shares at a discount. And the buyer's buying a minority interest each year and not 100% control. So that's why the price for the shares can be reduced. But there's still going to be double tax on the sale of those shares. And in this case, you have 30% to the buyers and 20% to the owner. So that $5 million is going to net the owner $2.8 million. But the other $5 million is going to be paid to the owner directly as some type of deductible compensation. Could be current or could be deferred. And because it's a deductible expense to the company, it's taxed only once to the owner at their 30% rate. So that nets them $3 million, $3.5 million, right? So when you add those two together, you get the owner getting $6.3 million, which is $700,000 more than the other scenario where they're selling all their stock for all this cash flow. So from the same exact $10 million of company cash flow, our taxes drop from $4.4 million to $3.7 million. And also, because more of this is taxed only once, you're going to see in a moment that you're going to get paid faster in this way. So, which directly, again, reduces your exposure to that uncollateralized note that the owner may have taken back in the previous slide. So this is a clearly better outcome, a clearly better outcome than the full purchase price of the stock and subjecting the transaction to double taxation. You do some combination. I use 50-50 here. It could be, those percentages can change a bit, but by using a combination of stock sale and direct payments compensation, you're going to reduce the tax drag on the company cash flow. And we'll see in a moment how that's going to speed up the payment to the owner and get them the same amount of money with the same amount of cash flow. So let's talk about how you do this. I got to move my slides. All right. So I call this the two-step process. And I think this is, I borrowed this. This is not my own, to be honest with you. This is the Business Enterprise Institute, John Brown's platform and his model. Okay. So what happens here is in the first step, in this two-step plan, the owner sells about 30 to 40% of the company stock, non-voting stock, over a 3 to 4 year window. And they start gradually stepping back from the business. All right. So they're selling, 30 to 40% of the stock, non-voting, to the key employee, and they're stepping back. And this is exactly where that 50-50 blend actually happens in practice. The stock is priced at what we call lowest defensible value, which is a real defensible value and has a defensible discount. And the key employees pay the owner with promissory notes for those shares, funded by the increased cash flow they help generate. That's the stock side of this split. So they're going to use the cash flow that's going to be distributed to them as new owners, as owners. They're going to use that cash flow to pay the original owner on the note they gave that owner for the shares that they're buying. Now, at the same time, whatever cash flow remains is going to be paid out directly to the owner as either as additional compensation or distributions, or even to fund a non-qualified deferred comp plan. So that's the direct payment side of the split. And it runs in parallel with the stock sale, not after it. All right, that's step one. Step two is on the right side is once the key employees or key employee gets to 30 or 40% and has a proven track record of running the company, then they can go out and finance the rest with the buyout with outside bank debt. Okay, so they go out, borrow money, and they then give that money to the owner. And this is worth repeating every time I mention it. So the owner then, and only at that point, gives up voting control when they receive this final payment for their shares, right? Not a moment sooner. So this step is also what finally retires the risk we flagged earlier, which the one-step process or the two-step process closes where that unsecured seller note is paid off in full, and that exposure disappears. So now we've seen this problem, as far as the double tax, and this is how we could fix it with this two-step plan. We can get more money out. And the next thing is, how does this work? And why is it beneficial to do it from the owner's perspective? And let's move to the next slide here. So here's an example. This is the same structure, same numbers. And here we have that company. Let's assume the company is worth $10 million. The free after-tax cash flow is $1.75 million a year. And I want you to look at it. If you take a look at that, and let's assume if we do a properly structured two-step plan, where we split stock purchases with direct payments of compensation, we just walked through in that last slide. If you do the math, and I can share it with you if you'd like, but I'm not going to do it here. By the end of year 4, with that same $10 million, the owner is going to receive approximately $8 million. Okay, at the end of year 4. Now, look at the bottom timeline. If we don't do this split plan, right, combination of stock purchase and direct payments and direct compensation, if we do this outright sale of stock, okay, the same approach the first slide I showed you with, where 100% of the stock is sold up front, financed entirely by a note paid over time, fully subject to double taxation along the way, it's going to take 6 years for that same $10 million to get to $8 million for the owner. Okay, so here you go. I mean, we're saving taxes, but not only are we saving taxes by reducing the tax drag on the transaction, we also shorten the period of time necessary to get the owner their money, and therefore, we reduce their risk. So that's kind of the benefit of using that two-step plan. 2 years faster to get the money with the same amount of cash available, free cash flow available, and it's because we basically taken a lot of the tax drag out of the transaction. So that's the complete arc here, right? We start from a plan that's both tax inefficient and generally risky, and through the fix I just mentioned to you, that two-step plan, and how to implement it. Again, we get it down. So not only do we save money, but we get the owner paid faster with less risk the whole way through. So this is a little self-promotion here. Excuse me for doing this, but if you want more information on this, I want to point out to you a resource in case any of this two-step material is something you want to go deeper on with a client, or you just want to have it on hand as a reference. Everything we just covered, the double tax problem, the 50-50 fix, the full mechanics of the two-step plan, is laid out in detail in my book called The Inside Game, How Your Employees Can Help You Cash Out of Your Business and Retire in Style. Okay, it walks you through the entire two-step plan, how each tranche gets actually priced, and how the key employees' promissory notes get structured. It includes real worked examples, the same numbers we just walked through together in more depth, and it covers how to close the gap between the lowest defensible pricing and the owner's walkaway number using non-qualified compensation or direct payments. And if a client situation looks anything like what we just covered, this is a good next step to hand them or to have on your own shelf as a reference the next time conversation comes up. And if you are listening and if you want to, you can send me an email and I'll send you a free digitized copy of this book. It's a digitized copy. If you want a hard copy, it is available for sale on Amazon. Okay, let's move on. Now, that's that two-step structure. Let's talk about something that comes up from not too often, but it has come up for me. And in this situation, here we have a general contractor, and the owner's key employees are fully capable of running the business, right, day to day, but there's no outside buyer lined up. There's no ESOP. It isn't quite the right fit here either. But we'll get into that for reasons later on in this deck. But the owner wants to step back gradually over the next 5 to 7 years. They want to keep working, but they want to step back. They want to keep receiving income during that transition. They want to retain meaningful control until the successor team has proven itself. And there's a wrinkle here that's specific generally to contractors and general contractors in particular. Most of the times, and especially if they're growing, the growing general contractor business, after-tax profits need to stay in the business to support its increased bonding capacity, right? The surety is going to insist that they retain most of their earnings, build up their balance sheet so that they can underwrite and issue security credit for new jobs, excuse me. So this is really this old co new co structure is specifically designed for that circumstance because it's not just a tax question here, it's an operational one too. So what happens here, because you don't have this free cash flow to finance the transition, is you use this old co new co structure. And so what happens is a new company, we'll call it NewCo, is set up where the key employees own an interest, and again, we're using the profits interest that we talked about before. They get issued non-taxable profits interest to them, and the owner gets gets an interest in it as well. And so now what happens is all new contracts get put into NewCo. So NewCo starts with taking over and starts with all new contracts and all the new work, and it takes care of the day-to-day operations. While the owner keeps a controlling voting stake in the NewCo, sometimes around I've seen it around 40 to 45%, and frequently then those profits interest by the new owners, they're also they're vesting over time. So the new owners are going to have to earn their stake over time. So meanwhile, NewCo is getting all the work, performing all the work. And what OldCo does and continues to do is it provides financing, because NewCo may need money initially to finance operations. So OldCo will lend them money. And also they need bonding support. So the balance sheet of OldCo still needs to support bonding. And so in return for that, NewCo pays OldCo guarantee fees on the bonding and interest until NewCo builds up its own balance sheet. Okay. So it's a slow transition out of OldCo into NewCo. And the punchline here for the owner is that eventually, Mr. X, in our case, he's going to get redeemed out of NewCo gradually, usually at a formula price, and often at book value. So there really is no gain or loss on that redemption to him, right? Letting him de-risk his interest over time. And the equity that was built up in Oldco that he could not withdraw because of bonding needs now can be withdrawn, and it usually is going to be withdrawn tax-free because that equity, that buildup in NewCo was taxed already. It's usually an S corporation setting where that money has been left in, but it was taxed. So now the owner can take all that equity out of Oldco and get his money out of there as well. So this is another situation where there generally is no double tax here, right? But we've accomplished the transition from the old owner to the new owners without having to rely on cash flow, future cash flow that's required to be plowed back in the business for bonding needs. Okay, so it's kind of a very specific circumstance where this works. It's where, again, cash flow is not readily available to be distributed. It has to be accumulated. So this old new co structure is something that I've seen work. And then finally, we have the serial redemption plan, and that's another plan worth knowing about. And again, in the right situation, all these things have to be looked at, and they have to be fitted with the owner's goals and objectives. Instead of an insider, all right, or insiders buying the owner's stock at all, what we have here is the company itself buying it back from the owners gradually out of its own growing profits with no cash out of anyone's pocket up front. Okay, we're using company cash flow. We're using it to buy the shares from the existing owner over time. And generally, this is how it works. So each year, the company redeems, buys back, and retires a slice of the owner's shares, funded entirely by that year's growth and profits. Again, it's not by an insider's personal cash, not by a bank loan. And as those shares are being redeemed and retired, the successor's interest in the entity grows. Right, the successors are either sold at the beginning a small amount of shares, or they buy a small amount of shares. At the beginning, so that as the owner's stock gets redeemed over time, their percentage interest in the entity increases to the point where they become the 100% owners. Right. So the reason why this is worth of real attention is if you do it correctly, and there are some parameters, tax parameters that have to be followed. The redemptions can be structured as a tax-free return of the owner's investment rather than as a taxable sale, as long as their basis keeps pace with the redemptions year by year. And so that's a pretty interesting outcome there, right? There's no double tax at all in this structure, and the owner gets paid for their shares. The couple things you need to note here, though, is that you can't have a locked-in master agreement. There can be no guaranteed paid out schedule, and this could take anywhere from 5 to 10 years to complete, because each year's redemption has to be a real separate business decision on its own terms, and a general discretion. And that genuine discretion is exactly what preserves this favorable tax treatment. If you lock it into a fixed contractual schedule, you risk losing the treatment entirely. So the honest trade-off here for the owner is that, they're going to retain ownership for a while, and the financial risk that comes with that for the whole life of the plan. And there's no early lump sum payout here like there was in the two-step plan, right? They're not going to get cashed out after 3 or 4 years. They're going to have to stay in until all these redemptions take place over time. So this is a more patient, multi-year strategy that depends on the company staying profitable the whole way through. But, for the right owner, someone who's comfortable staying invested and doesn't need a quick exit, tax-free is tax-free, right? And that's worth serious consideration. And also, in this structure, you're not putting more debt. You're not putting more debt on the company balance sheet. You're not saddling the company with more debt to effectuate the plan. So, again, all these things in the right circumstances, given the right owner objectives and cash flow, these could work. So you have to look at each one separately and see which one fits. All right. moving on to the more mundane stuff. Let's shift gears, guys. Let's talk about everything now here from now on is probably in the next couple of minutes is going to talk about layering a trust structure on top of the sale to shift more value to the next generation tax efficiently. So we're going to spend a meaningful chunk of the next several minutes here with trust to show again how, and these are more advanced strategies, how, for example, a sale to a non-grantor trust, the sale to an intentionally defective grantor trust, also known as an IDGT, and a charitable trust. At the very end, all build on the same foundational vocabulary we're about to cover. So if you only remember one section worth of terminology from today, make it this one. Sorry, I'm using my voice here. Let me take a little sip of water. Let's talk a little about trust. I don't want to get too deep in this, but you can get real deep. Let's talk about this now. There's a distinction. We're going to talk about a grantor trust, and we're going to talk about a non-grantor trust. So the grantor trust is a trust where the person who created the trust keeps key levers of control. They have the ability to revoke the trust. They can change the beneficiaries. They can direct investments. And the income is directly taxed to the grantor. So from a tax perspective, a grantor trust is really not even, from an income tax perspective, a grantor trust is really nothing. It's a non-entity, right? It's the owner. It's as if the owner owns the assets for tax purposes, income tax purposes. Even though the assets are in a trust, for tax purposes, it's still considered to be the owner's property, right? And so that's what a grantor trust looks like. Now, if you have a non-grantor trust, that's completely opposite, right? In that trust, the creator of that trust gives up all rights entirely. An independent trustee makes decisions, right? For income tax purposes, it's its own separate tax-paying entity. And for estate tax purposes, whatever is in that trust is excluded from the creator's estate. It really stands on its own. Now, here's the bridge to the next slide, and we'll get to that. This intentionally defective grantor trust is a deliberately engineered version of the grantor trust that gives you the best of both of these worlds at once. So you get the trust is ignored for income tax purposes. So for income tax purposes, it doesn't exist, but whatever is put in the trust is outside of your estate. And that's why they call it defective. It sounds like a crazy name, but that's what it is. It's described as. So I know this can feel a little dry and technical the first time you hear it, but stick with me because every strategy for the rest of the presentation here on these trusts is really a variation of which of these two boxes an asset sits in and who's paying the tax bill on it. Okay. So let's talk about this intentionally defective grantor trust, often referred to as an IDGT. Okay. It sounds alarming. It's effective, but don't be alarmed. Okay. Defective only refers to the income tax status, right? The grantor is still treated as the owner of the trust for income tax purposes, but the trust is drafted specifically to avoid the kind of retain rights that would otherwise pull the assets back into the grantor's taxable estate. And the result here is that the grantor personally continues to pay the trust's income tax, which lets the trust assets compound completely tax-free from the trust's own perspective, while those same assets sit entirely outside the grantor's taxable estate, assuming the estate planning is properly respected. So think of the IDGT as a workhorse vehicle behind several of these sales techniques we're about to cover. We're going to talk about a sale to a non-grantor trust, and then we're going to talk about a sale to an IDGT itself. If the client ever pushes back and asks you why would anyone deliberately keep paying tax on money that's no longer theirs, that's outside their estate? And here's the answer worth having ready. So every dollar now of income tax that the grantor pays on the trust's behalf is itself an additional completely gift tax-free transfer to the beneficiaries. All right, so you're not just avoiding a bad outcome. you're actively accelerating the wealth transfer every single year the trust exists. So what happens is, whatever the tax consequences are that are going on in that IDGT, that intentionally defective grantor trust, the grantor is using their other assets to pay the tax burden on that, and that's further enhancing, and it's reducing the grantor's otherwise taxable estate, but it's also preserving the value that those assets outside the estate. So that's why these things are set up. It's to accomplish both things. Now, here's an objection I hear about all the time. And here it is. What if I need access to this money, Mike? Okay. I hear this every client tells me this. All right. This all sounds great, but I'm putting this stuff outside of my estate. There's an independent trustee, can't be me. But what if I need access to that money? I'm not willing to step away from that. I'm giving up control. Well, there is an answer. I mean, the estate planning community has come with a solution to that problem, and it's called a SLAT. Okay, a SLAT stands for a spousal lifetime asset trust, and there are two flavors of the SLAT. There is a SLAT, which can be drafted as an IDGT, where the grantor keeps paying the income tax, which we just discussed. And then there's also a SLAT, which is a non-grantor version, where the trust pays its own tax as a completely separate taxpayer. Different planning goals call for different flavors. And this comes up a lot in almost every conversation without fail. So I want to give you some real airtime here rather than rushing past it. Business owners have spent, as we know, decades building liquidity discipline into how they run their company. And the idea of permanently, irrevocably giving away a large piece of that liquidity, putting it into a trust outside their estate, makes people nervous. It makes people nervous. But the SLAT and the SLAT are really the industry's answer to that very human hesitation. So let's talk about what these things are. So what is a SLAT? A SLAT is an irrevocable trust that one spouse creates and funds for the benefit of the other spouse, often with children and grandchildren named as additional beneficiaries. So 3 things to know about these. First, what moves out? The assets that are transferred into the SLAT plus every dollar of future appreciation are removed from both spouses' taxable estates. Okay, the money's outside your estate. Secondly, what stays accessible? The beneficiary spouse can still receive discretionary distributions of income and principal. So as a couple, you retain practical indirect access to the wealth during your lifetime. So your spouse can get a distribution from this trust, and because that person's your spouse, you indirectly have access to that money, right? And third, who pays the tax? Well, typically the donor spouse personally, which lets the trust compound without that tax drag we talked about. Excuse me. So the ideal client for this is, again, high net worth couples who want to lock in today's gift and estate tax exemptions, move appreciating assets, including business interests, out of their estate, and still keep some practical access to the wealth through the beneficiary spouse. And one more practical point worth noting here, because SLATs are irrevocable, the choice of beneficiary spouse matters enormously, and so does the state you're in. So some states offer far more favorable trust and asset protection laws than others, which is part of why an experienced trust counsel usually gets involved early in this conversation, not after the documents have been drafted. Okay, so that's a SLAT that gives you, the taxpayer, the owner, even though this stuff is moved outside their estate, even though they don't have control of it anymore, they do have indirect access through it, through this spousal lifetime access trust mechanism, where their spouse can get discretionary distributions from the trust when they need them, if they need them. And so they can get access to that money. So it's not totally outside of your reach. Now, let's talk a little bit about sales to a non-grantor trust. Okay, let's put some real numbers behind this. And here's a business owner with a $3 million company. Let's assume she and her spouse don't have an estate tax concern. They're well under the $15 million exemption. But they're planning to sell it in the next 3 years. And without any planning, assuming their tax basis is close to zero. The federal tax bite on that $3 million sale at 20% will be $600,000. Now, here's the planning move. Okay. Sell that business today, not in 3 years, to a non-grantor trust or a spousal non-grantor trust, a spousal lifetime non-grantor trust set up for your family. And in exchange for that, the trust will give her a 30-year promissory note at 6%, payable, prepayable, in whole and part at any time. So let's look at what happens with this structure and what happens to that $600,000 tax bill. So I want to slow down on the numbers here because this is a slide where the abstract idea of selling to a trust turns into something concrete you can actually explain to a client with a calculator in your hand. Okay, so let's look at what happens here. So follow the flow in this diagram. So I have Mr. X here. Sorry, I called her she, but Mr. X sells the stock to the trust for $3 million. And let's assume his cost basis is zero. So the gain is the full $3 million. Excuse me. But critically, the gain is only taxed as he's going to receive payments on this note that he's getting back from the trust, which can stretch out over or up to 30 years. So there's no immediate tax due, right? But it's going to be deferred. Now, let's look at the trust. So the trust now owns this business. It has a $3 million tax basis in the business. And when the trust turns around and sells that same stock or the business to an outside buyer for $3 million, its cost basis is $3 million. So there's exactly, which is exactly what they pay for the share. So the trust recognizes zero gain on the sale, all right, and pays zero tax on that sale. So here's the number I really want you to sit with. The trust ends up with the full $3 million to invest, right? As compared to only $2.4 million if he, or the owner here, Mr. X, had sold the stock directly and paid the tax up front. So that's almost 25% more money available, right, than the situation if the full tax was paid at the time of sale. So I want to pause on one more number here before we move on because it's easy to breeze past this. This diagram is really showing you the entire economic argument for the whole strategy in one picture. So what happens is the seller ends up with a note, all right, instead of cash, but the family, taken as a whole, ends up with meaningfully wealthier than if the seller had simply sold directly and written a check to the IRS, right? So the trust is getting $3 million and as opposed to $2.4 million. So let's look at the income tax effects here. So because the gain, again, is only recognized as a note is no principal is received by the owner, it's spread out over 30 years, all right? Because that's the case and the owner is going to pay the tax on that sale over 30 years, the trust in the meantime gets to invest the full proceeds of the sale. And here's where we can talk a little bit about bracket management here. So let's say $100,000 of principal comes in during a given year, paid out on the note, and the only other income the owner has is a 6% interest on the note. So that $100,000 of capital gain, because of the low taxable income here, he only gets taxed at 15% instead of 20%. So by using some tax bracket management here, we're going to save about $5,000 every year on each of those $100,000 note payments. So over a 30-year period, that works out to be $150,000 of tax savings, right? Just by using that tax bracket management technique. But the real benefit here, the real arbitrage, the bracket arbitrage isn't the real event here, right? The real wealth driver here is compounding. All right, having that trust keep the full $3 million invested inside that trust instead of paying the tax up front and investing only $2.4 million. If you do the math, and I've done it, you can add another $2 million to the family's wealth over that 30-year period of time. All right, I want to let that sit for a second. Nearly $2 million. All right, not from that clever tax arbitrage strategy, but by simply letting the whole pie keep compounding instead of taking almost a third of it off of the table on day one. All right, so this is the benefit of this. So I want to, this is something that you can effectuate and do, but and the savings here are really tremendous. Now, we got to talk about some of the limiting factors here, all right? So here's one that comes up, and sometimes people can't get by it, and that is the sale to the trust has to happen at least 2 years before the sale to the outside third-party buyer. Okay, that's a timing rule that you cannot skip. So again, planning early makes sense, right? You got to have that trust has to own that property, that business for more than 2 years for this to work. Secondly, because you're the owner is reporting the gains as payments come in over time, you do have some capital gains tax exposure risk. So if when you receive these payments, the capital gains rates go up, you're taking some risks there. All right. And thirdly, even though the trustee can technically be your spouse, the owner or your spouse, the powers are going to need to be tightly limited. And it's generally safer to use family members like a sibling or an adult child instead. And if it's a SLAT, we set it up as a SLAT, then of course we can have indirect access to the trust assets through our spouse. Okay, so that's the benefit of doing this sale to a non-grantor trust, but you got to have at least 2 years, a 2-year runway. Now, what if you don't? Okay, let's talk about monetized installment sales. I'm sorry, structured installment sales, not monetized. So these are very popular in today's literature. I see it all the time. A lot of people, especially MetLife, they're kind of promoting these things, and they're valid. So we can have the same $3 million company, the same $600,000 unplanned tax bill, but this time the sale is going to happen in the next 2 years. So it's too soon. It's too soon to clear that 2-year minimum we just talked about for the non-grantor trust sale. So what's the alternative when you don't have that runway? Well, the alternative is to have a structured installment sale. And this one has no waiting period at all. So it's really one of the most common real world situations I run into, where the owner's already deep into a deal conversation, and sometimes with a term sheet already on the table, who's hearing about advanced planning for the first time. And the good news is that even with much shorter runway, there's still a real IRS sanctioned tool available, and that's this structured installment sale. So the way this works is 3 steps. Basically, instead of taking cash at the closing, the seller agrees to a series of customized future payments. Then the buyer's payment obligation gets transferred to a third-party intermediary who funds the payments to the seller. And step 3, that intermediary takes the sales proceeds, buys an annuity or sometimes treasuries to fund that scheduled payments going forward. And the tax benefit here is gain is only recognized as those payments are actually received, deferring the capital gain while creating predictable, often guaranteed income stream, frequently at rates better than the seller could find on their own, because the whole structure gets negotiated right at the deal table. And I want to be candid about the trade-off here, because your clients will ask you about it. Once this is set up, the seller generally cannot accelerate or access principal beyond the agreed upon payout. There's also no control over the underlying investments. There's no collateral if the intermediary goes into default, and you don't have the upside of the compounding that you would have that we showed you in that sale to a non-grantor trust. So it's not as good, but in the right circumstances, it could work if you want to defer tax. Watch out for this, though. Now, there are some products out there that say, hey, we can defer the tax for you, similar to the structured installment sale mechanism, but we'll allow you to borrow money against that future payment stream, and we'll give it to you. You could borrow against it, and we'll give it to you up front. Watch out for these. These are called monetary installment sales. I can tell you this. The IRS has designated these transactions as listed transactions, which means you have to report them on your tax return. And they're also on the IRS's dirty dozen list. So I would steer clear of them. Okay. Anytime a client tells you or gets pitched on, hey, I can get my cash now and defer the tax later, they're probably being pitched a monetary installment sale and not a legitimate structured installment sale. And I would say run. Okay, run and keep running. Okay, so let's talk about a little bit about which one do you actually pick? Do you use a structured installment sale, or you use a sale to a non-grantor trust? And again, the choice really depends on the client. If the client wants something straightforward, tax deferral, guaranteed cash flow, minimal complexity, they're comfortable with the insurer level returns they're going to get. There's no need for ownership or control of the funding assets, and there's no two-year waiting period involved. Then they'll probably lean toward a structured installment sale. But on the other hand, if they have that 2-year window, if they want to stay in control of the assets, if they want to focus on long-term compounding of the full sales proceeds outside their estate, and they're willing to accept irrevocability, investment risk, and complexity around the trust, then this may be the one to choose, sell to a non-grantor trust. But in any case, stay away from monetized installment sales. Run. Let's talk. We don't have much time left. I probably ran over. I want to talk about the sale to an intentionally defective grantor trust. Okay. I've seen this one used quite effectively over the years. So let's go through this. All right. So here we have a case study of John. He's a 60-year-old guy. He owns a rapidly growing S corporation valued at $12 million. Let's assume his tax basis is $2 million. This one business is pretty much dominant in his estate's net worth, and left as is. As it grows, it's going to create a serious estate tax problem for him and his kids when he passes away. And he has two specific goals. He wants to move all of this business's future appreciation out of his estate without triggering current income tax or gift tax on the full $12 million value. And he wants to keep paying the income tax on the business's income himself personally, because doing so actually supercharges the wealth transfer to his family. And we'll see exactly why in a moment. So I like using John's story specifically because his situation is generally common among fast-growing founder-led businesses many of you work with. You have a single concentrated asset that's grown well past and growing well past what anyone expected when the company is founded. And here's how this thing plays out. So here's what happens. So John first he's going to have to seed or make a gift to the intentionally defective grantor trust with $1.2 million of cash. It's a gift. It's a taxable gift. It's going to have to report it. It's roughly 10% of the company's value. And that's something that establishes real economic substance for the trust, something the IRS really wants to see. Secondly, John's going to sell $12 million worth of his company's shares to the IDGT. And in exchange, he's going to get a 12-year interest-only note at the applicable federal rate secured by those shares. So he's really taking a $12 million note in exchange for a $12 million business. So right now, he's moving the $12 million out of his estate, and he's getting a $12 million note back in his estate. So there really is no shifting of value yet. He's just swapping assets, right? A note for a business. And that sale is not taxable. I'll get to that in a minute. Third, because the IDGT is a grantor trust, again, and this is why. Because it's a grantor trust, the sale is completely ignored for income tax purposes. There's no capital gain to report, no taxable on the gain on the sale. There's no taxable interest income to John when he gets the interest. And the trust really carries over his tax basis in his shares, which is $2 million. And fourth, here's the growth scenario that makes this so powerful. If the business grows from 12 million to 20 million, the note simply gets repaid at the original $12 million back to John. But that $8 million delta of appreciation belongs to the trust and passes on to his heirs entirely outside of his taxable estate. And there's the supercharging piece worth directly here noting, right? John keeps personally paying the trust's income tax out of his own pocket, which is itself another entirely tax-free gift to the trust beneficiary because he's covering a tax bill that would otherwise have reduced the trust's own assets. So it's worth pausing to notice something structurally important about this plan. Every single step here is something the IRS has explicitly blessed through decades of published guidance and case law. There's no gray area or aggressive position anywhere in the structure. That's why it's become one of the most widely used estate planning techniques among sophisticated estate planning attorneys. And here's a little diagram of it, where you can see what happened. John sells his stock to the IDGT for $12 million. Cost basis is 2. His gain is 0 because for income tax purposes, it's disregarded. Then the IDGT turns around and sells the same stock to an outside buyer for $20 million. Now, on paper, that's an $18 million gain and a hypothetical $3.6 million tax. But none of that is paid by the trust. All right? None of it. I want to repeat that. It's not paid by the trust because it's the part people find hardest to believe on first hearing. The sale from John to the trust is a non-event for income tax purposes, full stop. When the business is sold, the tax due on the sale, even though it all goes to the trust, it's paid by John, further reducing his taxable estate. So the end result here is the trust holds the full $20 million with no tax paid on that value. John holds a $12 million note, okay, which is part of his estate, but now, it's still well under the estate tax exclusion, so there's no estate tax there either. And as he gets paid on the note with interest, it funds his lifestyle with none of those payments subject to income tax. So this diagram is worth noting. It kind of highlights how the transaction worked. And then to make this a little more, let's make sure that the mechanics are crystal clear. Here's the effect, right? So the gain again is not, it's taxed to John personally. He's choosing to absorb the tax on the sale of the business, and he only holds that note, that $12 million note. And the way I like to summarize this is that it's really a freeze, right? The business growth and the sales proceeds leave John's estate, and only the note's present value remains. And even that shrinks further. John keeps paying tax on the gain through future, and keeps paying tax on the gain from the sale and on the trust's future earnings. So it's a pretty neat structure. And also, if John is married, he wants access to the monies, indirect access. That IDGT could be a SLAT as well. George, do I have some more time, or do I have to wrap it up?
Well, we've run a little bit over, but I'm here and
right.
happy to keep going, man.
I'm not trying to rush through, but I guess I am.
Well, QSBS is something that's very front of mind right now. So
yeah, I talked to him about this. So let's move out of the trust realm because those things get a little complicated. Just a little more straightforward, right? So everything we talked about at this point is about deferring tax or shifting it to someone else into a lower bracket. And so this next section is really about getting to zero, okay? Let's talk about getting to zero income tax. And QBS, which stands for Qualified Small Business Stock, comes from Section 1202 of the Internal Revenue Code. It can let eligible non-corporate shareholders exclude up to 100% of their gain on qualifying stock, a true 0% federal income tax on the excluded portion, up to a certain statutory maximum. So let's talk about that. So the company has to, first of all, it has to be a domestic C corporation. Okay. The stock has to be acquired at original issuance. It has to be acquired directly from the company, not bought later on a secondary market. And the corporation has to pass gross asset test and use at least 80% of its assets in an active qualified trade or business. Now, there's holding period requirements. Now, they've changed recently. All right. So for stock issued on or before July 4th, 2025, it's an all or nothing proposition. If you hold the stock for more than 5 years, you get 100% exclusion, but that exclusion is capped at the greater of $10 million or 10 times your stock basis. Okay, so it's $10 million or 10 times your stock basis, whichever is higher. And if you hold it for more than 5 years, that limit is per shareholder. It's a per shareholder limit. Okay, now For stock issued after July 4th, 2025, under the One Big Beautiful Bill Act, that replaced the cliff vesting with a tiered schedule. So under that new rule, if it's the stock issued after July 4th, 2025, if you hold it for 3 years, 50% of the gain qualifies for the exclusion. If you hold it for 4 years, 75% of the gain qualifies for the exclusion. And if you hold it for 5 years or more, you get the full 100% exclusion. And the cap was raised from 10 million to 15 million, or 10 times your basis. And the company's gross asset ceiling was raised from 50 million to 75 million. And so that's important to note. One nuance also worth flagging here is that any portion of the gain that isn't excluded under those tiers gets taxed at 28%, not 20%. Okay, so that early exit isn't entirely free. So I'm going to take a breath here, but this is generally the most powerful provision in the entire code for a business owner who qualifies, and it's also one of the most underused, simply because so few advisors outside of specialized tax practices really understand it and to spot it early. Okay, so let's talk about what qualifies. There, certain businesses qualify and certain businesses do not qualify. So let's talk about what businesses qualify, because again, let's talk about the ones that don't qualify on the left here. So any business that really depends on the reputation and skill. Say again? I'm sorry. So any business that depends on the reputation and are skill-based service businesses like health, law, accounting, consulting, professional service type businesses, they don't qualify. Nor do banking, insurance, financing, and investing businesses. Most real estate development and real estate operating businesses don't qualify. Farming, mining, extraction businesses don't qualify. Hotels and restaurants don't qualify. And then one thing that surprises a lot of people is that S corporations aren't eligible issuers either. So QSBS is strictly a C corporation benefit. Now let's talk about what businesses do qualify. So if the business manufactures a product, if it has technology, selling technology, if it's in an SAS business, if it's in fintech, crypto, life science platforms, it could be R&D and life science companies. If it does retailing or wholesaling, when the value comes from a product, those are the kind of businesses that qualify. So if your client company fits into one of those buckets, the ones that qualify, and it's a C corporation, or it could become one, then this QSBS deserves a serious look well before any sale process begins. And also, I would mention that when you are starting to talk about, when your client's talking about forming a new company, if it could qualify for QSBS, that is the time when you have this conversation about electing or becoming a C corporation at the very outset, instead of waiting and not doing it from the beginning, because while you can get there later on, it's not as good. Okay.
So if you convert, Mike, from an S corp to a C corp, it's 5 years after the conversion, right?
Yeah, let's talk about that. I'm getting there now. Okay.
Oh,
First, let's get there, because I'm going to talk about if you're an S corp now and how you can get there. Okay, but that's the third step here, right? Let's talk about three things that change this math. All right. The first thing is the sale of the business has to be of stock, not of assets. Right. So you got to sell your stock to get the exclusion. Excuse me. But if you have someone who wants to buy your assets, QSBS can still help. It mitigates the tax on the C corporation liquidation, but you're still going to pay one level of tax at 21% at the C corporation level, right? But that's a different calculation. So it can ameliorate an asset sale on a C corporation, but it doesn't give you full exclusion. The other thing you have to also pay attention to is distribution planning matters a great deal here. So if during the duration of the company, if most of the company's profits are being pulled out along the way rather than being reinvested, then QSBS may not be the best fit, since these ordinary distributions are going to be taxed up to 40% versus generally 30% if the entity were pass-through entity like an S corp. So you got to run the numbers here, because you may be paying a lot more additional current tax on money taken out than you would be if you remained an S corporation. And you got to compare that difference to the savings by being a QSBS entity. And third, and this is your point, this is your question, George, if the company is currently an S corporation, it can reorganize. You can go through a tax reorganization into a C corporation to become QSB eligible, but only the appreciation that accrues after that reorganization counts toward the exclusion. Okay, so if you have a company worth $5 million today, and when you sell, you think it's going to be worth $20 million, and you're an S corp, you can reorganize it and get into the C corporation structure, but the entire $20 million will not be eligible for the exclusion. It's only the appreciation post reorganization, which in this case would be $15 million. So it's better if you see it early, if you catch it early enough. It's still, you got to run the numbers. And you got to make sure that it makes sense to do it. But there's a lot of analysis that has to be done here. But if you can get into this structure and you can exclude now $15 million a gain per shareholder, it's a zero tax situation. It's a zero tax situation. Okay.
Awesome.
Now, I can get into this too. I'll go through this really quickly, and you may have a situation where, I'm a C corporation, but you know what? I don't qualify. I'm one of those prescribed entities. I don't get to qualify for QSBS, or it's too late. I mean, I don't qualify, and I'm one of those prescribed companies. So what do I do? So how do I avoid, if I have to sell my assets, how do I avoid paying tax at the C level and then paying tax on the liquidation of the C corporation again, the double tax situation, right? So the answer here is goodwill, personal goodwill. So let's talk about that. So personal goodwill is the intangible value of an individual's reputation, skills, and relationships within the business. And critically, it's not owned by the business, it's owned by the individual and not the company. So you may have an owner that owns a C corp that doesn't qualify for QSBS, looking to sell, and it's going to be an asset sale. And he's worried that the buyer's going to buy all the assets, including intangible values. And if he does that, and all his personal goodwill is lumped into the company asset bucket, then there could be double tax on that transaction. So what people do is they identify their personal goodwill, which is something they own, and they sell that separately outside the C corporation to the buyer. And now that only gets taxed at one rate. It's capital gain. It's a capital asset, and they only pay 20% on that portion of the gain. And I can go deeper in there, but that's kind of the essence of personal goodwill. Okay, you can carve it out, sell it separately, get a better result. Okay, but you got to do it before the transaction. You just can't do it at time of closing. Let's talk about ESOPs, right? ESOPs are another.
I'm gonna have to drop off. Keep going. This is great stuff. I'll watch the rest of the recording.
I'm almost done. I got 5 more minutes. So let's talk about ESOPs. So ESOPs are another way of getting to zero, right? So what is an ESOP? Well, really, an ESOP is really nothing more than a tax-qualified defined contribution plan designed to invest primarily in employer security. So here's how it works, right? So the business owner sells their stock, anywhere from minority interest up to 100%, to this ESOP, which is, again, a qualified plan. And in exchange, the owner gets either cash, which is often borrowed from a bank, or maybe even a seller note. And so this is really a tax advantage leverage buyout of the company by its employees, right? Because the ESOP is the beneficiaries of that ESOP are the employees. So one of the things that needs to be noted here is that the employees don't hold the stock in the company directly. It's the trust. It's the plan that holds the stock. The employees are just beneficiaries of those shares. Okay, so again, and this is a way of selling the owner to sell their company at fair market value and exit. Now, let's talk about how this works at a very high level. So what happens is The ESOP is sold. The company is sold. The ESOP gives the owner either stock, either cash or a note, but mostly cash because the ESOP borrows money to buy the owner out. And then here's where the zero tax thing comes in. Under Section 1042 of the code, if the owner is the owner of a C corporation who sells their stock to an ESOP, they can take that money, they can take those proceeds, and if they reinvest them into qualified replacement property, which in this case is our stocks and bonds of U.S. companies, they can defer the tax on that gain. Okay, so if they take that money and they reinvest it in a portfolio of U.S. stocks and bonds, they defer the tax on the gain, and potentially they can get rid of the tax entirely. And I'll talk about how that could happen in a minute. But if the company, though, is now an S corporation and is not a C corporation, then what I see owners doing is they revoke their S election before they get into the ESOP transaction. So they're a C corp when they sell, so they get this deferral opportunity, and they have to wait, and they do 5 years, and they reelect S status. And once they become an S corp again, and if they're owned by an ESOP, then guess what happens there? There's no tax ever paid on those S corporation earnings because the ESOP is tax exempt. Okay, so here's how that rollover becomes indefinite and the tax is never paid. So if that qualified replacement property is held until the owner's death, then their beneficiaries get a basis step up to fair market value, and so the deferred gain in those shares and in that qualified deferred replacement property is never taxed. And how do they get access to that money during their lifetime? If they sell the shares, those assets, they have to pay tax, so they can't sell it. But what has been put in place, and there are mechanisms whereby the owner can borrow money against that qualified replacement property, so they can borrow against it and not sell it to get asset access to that wealth. So that's kind of in a very quick way how with an ESOP the owner can get to a zero tax situation. Okay, so and then we can talk about the pros and cons of that. For the employees, it's great because they keep their employment, they gain control of their careers, they have an equity position, they have flexibility. The owner is great about it. The good things for the owner is that they can roll over the gain. They can do a partial or control sale. They can still work. They can still control the company. They could be a shareholder. I'm not a shareholder. They could be an officer. They could be the president, and they could still work in the company. And the company also has some strategic opportunities. You have great morale. You have a better retention because people feel like they're building something for their retirement. Because when the employees retire, they get paid out the fair value of those shares when they leave the company. Okay, so that's kind of a quick view of the ESOP. And then we have the charitable remainder trust. Okay, so right now we've talked about zero tax, but this is not a zero tax situation, but you may have situations where people want to be charitable. Okay, and so what they can do here is they can set up something called the charitable remainder trust. Okay, and what happens here is they commit that whatever they contribute. I'll do it real quick. So what they do, I'll go to the diagram. Let me do that. So what the owner does is they contribute the shares of their company, and in most cases, it's going to have to be a C corporation. I can tell you that. So this is another case where the owner, if it's an S corp, and he wants to do something charitable with the business, he's going to have to convert it to a C corporation. They make a gift of the C corporation to this charitable remainder trust, which is set up for charities, for a charity or charities, and they get a tax deduction equal to. And so they make a gift of the shares of the company to the charitable remainder trust, and the trust provides that, and in return for that contribution to the trust, they get a lifetime income stream. So the trust is going to pay them a lifetime stream of income. And once the trust terminates, whatever's left in the trust goes to the charity. Okay? It's a charitable remainder trust. So what happens here from a tax perspective is that initial contribution is a charitable contribution. So they get a tax deduction for that, the actuarial value of that remainder interest. And that's calculated through complicated tables in the Internal Revenue Code. So they get a charitable contribution deduction and at the beginning. And then when the company is sold by the charitable remainder trust, there's no tax because it's a charity. No tax on the gain, no income tax is paid. And then the owner's getting this stream of monthly income for the rest of their lives. Okay. And they're paying some tax on that. They're paying tax on that. So it's not tax free. So, but again, this is for a person who really is charitably inclined. They want this money eventually to go to a charity, but during their lifetime, they want to live off the income stream, and they want to convert and they want to transfer the value or any value to a charity. So charitable remainder trust is another way where they can do that. Now, finally, I'm out of breath. What if you did no planning? Okay, and this happens a lot because oftentimes people call me and say, I'm about to close. I got an LOI. What can we do? Well, you haven't given me much runway. All right. But there is stuff you can do at the time or during the year of sale. Right. And so let's talk about those real quick. You're not out of luck. And these things are still worth looking at. So one of the things that has been put back into the tax law is these qualified opportunities on investments. And if you remember under the 2017 Tax Act, what these are essentially is these are designated areas designated by each state governor where they want money. They want money to be invested into these usually low income areas. They're growing areas, so they want money, taxpayer money, to go into it. So they offer investors a tax incentive. And what happens here is you can take any portion of your gain, not all of it, any portion of it. Okay, and you can invest in a qualified opportunity zone fund within 180 days of your sale. And if you stay in that fund for 5 years, the tax that you owed is going to be it's going to be deferred for 5 years. But when you have to pay the tax in 5 years, you're going to get a 10% haircut on that tax if it's a regular opportunity zone, and you'll get a 30% haircut if the zone is in a rural area. Furthermore, if you hold the investment for over 10 years and you sell, there's no tax at all on that investment. Okay, so you get a deferral, you get a haircut on that deferral. You're going to pay it, but you're going to get a haircut on the original tax, and the investment itself becomes tax-free after 10 years. Okay, good thing. You got to watch out. Don't make the tax tail wag the dog. Make sure the investment is sound from a real estate perspective or from a business perspective. Don't just go after it for the tax deferral and tax savings. It's got to be a good investment. The other thing you can do with real estate, if real estate's involved in the transactions, you can do a 1031 exchange. So everyone understands that. You can do a like-kind exchange. You can basically roll over the gain from the sale of the real property into another piece of real property and defer the tax on that. And the final thing you can do from a charitable standpoint, if you don't like the charitable remainder trust, because there's a lot of moving parts there. There's this, and people probably know about these. There's something called a donor advised fund, where you can make an immediate charitable contribution, even though you don't know what charities you're going to give it to. You may say to yourself, over the next 5-6 years, I'm going to give away $500,000, but I'd like to make that contribution in the year of sale. So I'm going to give $500,000 to a donor advised fund, and then we can decide later on where that money is going to go. You can do that. So these funds will allow you to take an immediate deduction for cash contributions that you make to it in the year of sale, and those contribution deductions can offset part of your gain on the sale of your business, and you avoid the complexity of the charitable remainder trust. So I'm out of breath. So those are things you can do post closing, so you're not out of luck. So again, sorry if I ran through some of that. I know I spent too much time, probably 30 minutes more than I intended to. But thank you again for your time. If there's one thing I want you to walk away with today, it's this. The difference between paying up to 40% or more and paying close to zero on the sale of business is almost always advanced planning, not luck. So there's no time for questions right now. And if you have any questions, I shared the deck in Circle. If you have any questions and want to talk further about any of the stuff that I tried to cover today, I'd be more than happy to talk to you. So send me an email and I'll jump on the phone with you. That's it.
Mike, man, thank you very much. What a great series. I really appreciate it.
I appreciate that. I think I ran through the trust stuff too fast, and it's kind of complicated. But anyway,
That's, and people can pick up the phone and call you or shoot you an email. And
anytime, and the deck is there. You can read the slides. The slides are pretty explanatory, even though I tried to rush through them. But in any case, my pleasure. Again, this is the stuff I do, and a lot of money can be saved if you do the right planning and you give yourself enough runway.
Plan. That's exactly right.
There you go, man.
Okay.
All right, George.
Awesome.
Everyone.
Thanks,
Take
Mike.
care.
I'll
We'll
talk
talk
to you soon. Thank you, sir. Really appreciate it.